This story did not stay inside Turkey. Erdoğan was sold as a force of stability, growth, and control. What started as a recovery story slowly turned into a warning about inflation, weaker money, and the cost of trusting political power more than economic guardrails. Why should you care right now? Because when a major economy breaks trust in its currency, the shock does not stop at the border. It spills into prices, markets, energy costs, and the wider fear that stability is more fragile than it looks. Most people hear the simple version. Turkey grew fast, Erdoğan stayed popular, and then things went wrong. But that misses the real story, because the damage did not arrive all at once. It spread slowly, first almost invisible, then suddenly impossible to ignore. And once those cracks reached the lira, inflation, and everyday life, the whole promise started looking very different. By the end, you will understand how Erdoğan first helped stabilize Turkey, how that success turned into risk, and why the Turkey inflation crisis became about much more than one bad year. You will see how growth, debt, politics, and the Turkish lira collapse all connect. You will also see why this is not just about Turkey, but about what happens when power starts rewriting the rules of an economy. Because this story is really about the price of stability when institutions get weaker and confidence gets personal. Stay until the end, because the final question might flip how the viewer thinks about Erdoğan's economic legacy entirely. Chapter 1. The Promise of Stability, 2003 to 2010. Here's the twist. Erdoğan did not first become associated with collapse. He first became associated with relief. After Turkey's 2001 crisis, voters were desperate for stability, lower prices, and a sense that the country could work again. So when inflation fell from around 54% in 2001 toward roughly 9 to 10% by 2004-2005, it felt like the economic storm was finally breaking. The proof was real, not cosmetic. World Bank data shows Turkey's GDP growth hit about 9.4% in 2004, 8.4% in 2005, 6.9% in 2006, and 5.0% in 2007, while foreign direct investment jumped from roughly $1 billion a year in the early 2000s to more than $22 billion in 2007. That is not just Turkey GDP growth analysis on a spreadsheet. It meant more jobs, more lending, more construction, and a stronger lira at a time when people wanted normal life back. Think of it like a household finally escaping emergency mode and starting to believe tomorrow might actually be better than today. But success changed the political game. As Turkey economic policy started looking like a success story, Erdoğan gained credibility not just as a politician, but as the face of stability itself. Once a leader becomes linked to growth, investor confidence, and lower inflation, people stop asking hard questions about how durable that model really is. And that's where the risk begins, when trust shifts away from institutions and toward one man. Because if that formula later changes, the damage does not stay in Ankara. Chapter 2. Growth at any cost. This is where the success story starts to feel dangerous. Turkey was still growing fast, but after 2010, the model leaned harder on cheap credit, construction, and foreign cash. In 2011, GDP growth hit about 11.4%, making the boom look unstoppable. Why does that matter? Because fast growth can hide real weakness when it depends on money that can leave just as fast as it arrived. It was like revving an engine hard and mistaking noise for strength. The problem was not growth alone, it was the fuel behind it. Private sector external debt rose from roughly $130 billion in the late 2008s to well above $300 billion by the mid-2010s. At the same time, construction became the symbol of the era. Airports, bridges, highways, housing, visible proof that money was moving. That looked powerful, but it also meant more exposure to foreign lenders, exchange rate shocks, and higher imported costs later. And that's the real shift. Turkey kept growing, but more of that growth rested on leverage and the belief that cheap foreign money would keep flowing. Think of it like building a bigger house with debt while hoping income never slows down. So this chapter matters because it shows when Turkey economic policy stopped being just about growth and started becoming a risk story. And once global conditions changed, that risk was about to collide with politics in a much bigger way. Chapter 3: Power Consolidation Changes the Rules. This is the moment when the market story stops being just about economics. After the 2016 coup attempt, power became more centralized, and investors started watching politics and the Turkey central bank almost as one story. And Erdoğan made that fear louder by openly arguing that high interest rates cause inflation, the opposite of what most central bankers believe. That's when confidence started to feel less like policy and more like loyalty. The proof was not subtle. Erdoğan fired Turkey Central Bank Governor Murat Çetinkaya in 2019, replaced Murat Ünsal in 2020 after the lira weakened, and removed Naci Ağbal in 2021, just days after a sharp rate hike. Reuters described that period as rapid turnover, with Turkey reaching its fourth central bank chief in less than 2 years. To markets, that sent a brutal message. If the bank resists the Erdoğan interest rate policy, its leadership can be changed. When institutions look weaker, money leaves, borrowing gets riskier, and pressure builds on prices, jobs, and savings. Think of it like a pilot changing the cockpit instruments mid-flight because he doesn't like what they show. For a while, the plane may still move forward, but passengers stop feeling safe, and markets react the same way. And once trust in the referee breaks, even small shocks can hit the currency much harder than before. That's exactly what makes the next chapter so dangerous. Chapter 4: The Currency Spiral. This is where the damage becomes impossible to hide. The Turkish lira collapse stopped being a market story and became a daily life story. $1 bought about 1.8 lira back in 2013, but by mid-2023, it had moved past 27 lira, a collapse that crushed purchasing power. Why does that matter to you? Because when a currency breaks like that, food, fuel, rent, medicine, and imported goods don't wait for economists to explain it. It hits the checkout line first. The policy response made the shock even harder. Despite surging prices, the Turkey Central Bank cut rates through 2021 and 2022, eventually bringing the policy rate down to 9%, even as official inflation hit 88.51% in October 2022. That's the core of the Erdoğan interest rate policy gamble, and it helps explain why Turkish lira falling so often became a global question. People reacted the way people usually do in a currency panic. They rushed toward dollars, tried to protect savings, and watched the cost of living crisis get worse. And that's when the economic trade-off turned brutally personal. The Turkey economic crisis 2022 was no longer just about charts, investors, or monetary theory. It meant weaker salaries, shrinking savings, higher grocery bills, and a deeper sense that the local currency could not be trusted. But once people stop trusting the money in their own pocket, the political consequences start to get harder to contain. Chapter 5: A New Economic Reality. Turkey did not stop growing. That's what makes this story so tricky. Even after the Turkey economic crisis 2022, the economy still expanded about 5.5% in 2022, 5.1% in 2023, and 3.2% in 2024. So the country did not fall into a clean collapse. It moved into something messier, growth without real stability. Headline growth can look healthy even while families still feel squeezed by prices, borrowing costs, and a weaker currency. That's the new face of Turkey economic policy. Inflation tells the other half of the story. Turkey ended 2023 at 64.77% inflation. Inflation then peaked around 75.44% in May 2024, and by March 2026, annual inflation had slowed to 30.87%, showing improvement but not normality. The lira also kept weakening over time, just less explosively than during the worst of the spiral. And that's the trade-off Erdoğan leaves behind. Erdoğan kept growth alive, but the old stability is gone, and the cost of living crisis changed how that growth feels on the ground. The country is still moving, still producing, still growing, but the margin for error is much smaller now. And the real unanswered question is whether Turkey can rebuild trust before the next external shock hits even harder. Turkey's story is not finished. Understanding it helps explain a bigger pattern. An economy can still grow on paper while people feel poorer in real life. Because once trust in money and institutions starts slipping, the fallout rarely stays local.
Turkey can still rebuild credibility, restore confidence, and change how investors and households think about the future. But that only happens when people stop treating slogans like economics and start watching the real signals: inflation, central bank credibility, debt, currency stability, and policy discipline. The next step is simple. Follow the numbers, compare the promises to the outcomes, and pay attention to how politics shapes the wallet. That habit matters in Turkey, and it matters almost everywhere now. So what does Erdoğan's record really mean? Did he save Turkey first and then damage it later? Or was the later crisis built into the model from the start? Can an economy keep growing if people stop trusting the currency in their pocket? And how many other countries look stable today but are hiding the same risks underneath? Subscribe, turn on notifications, and keep learning how geopolitics, economics, and power shape your everyday life. Because the next crisis usually starts long before most people realize it.